Welcome back. You're watching Traders Corner, and joining me as always is Garth McKenzie, founder and editor of Traders Corner. Garth, welcome.
Hi, Julieta.
Garth, last week we spoke about how the US markets were starting to push beyond the record levels set in January, and are they now, do you think, on a tear to a further leg higher?
It looks that way. The S&P 500 has now broken to a new all-time high. We've been watching this for weeks and weeks. It's saying that it's been grinding higher in this channel since April, when the market bottomed out. And you can see it's been trading in quite a nice, neat channel to the upside since then. Now, the previous high that was set in January was at 28.75, and that level has now been surpassed. As we sit here now, the S&P 500 futures are busy knocking on 2,900 at the moment.
Okay.
So we're well into new all-time high territory now. And I suppose the question from here is how high does it go, and does the pace of this move begin to accelerate, or doesn't it? And how much higher can it really go? But all in all, it looks good. And you'll see the other US indices. We're going to look at the Nasdaq in a minute as well. Those have been making new highs all along. So the S&P 500 is a little bit late to the party, in the sense that some of the other major US equity markets have already broken to new highs some time ago.
Yeah, I suppose it would have been quite nice to pick up a few S&P 500 or just maybe a long trade in the S&P 500, and you could have done that in July or May this year. But there was a lot of uncertainty at the time as to whether or not we were going to break down in those markets, as opposed to rally upwards.
Yeah, there certainly was. But I think I've been saying for some time that while the market's above the 50-day moving average, and while it's in that upward sloping channel, the bias definitely was to the upside. And it is easy in hindsight, I guess, but certainly we've been saying all along that you've got to give the upside the benefit of the doubt, given the chart structure the way it's been for the last little while.
And our own market is not looking too shabby either. This is very interesting. So we would have been, before we get there, the Nasdaq, and we're going to go back to that at some point because that's the trade this week. But just to highlight that for us.
Yeah, so I mean, we will revisit this because we're doing a trade on the Nasdaq, so we'll look at this chart again in a little while. But just while we're looking at the US indices, and what I was making that comment about the fact that the Nasdaq has been pushing up to new highs for quite some time, whilst we've been waiting for the S&P 500 to get to new highs. Now you can see what's happened this week is it's actually started to break to the upside through a triangular pattern, and that move through 7,500 on the Nasdaq 100 here is a bullish move that opens further upside. But you can see this market's basically been in new all-time high territory consistently for the last couple of months, very much outperforming the S&P 500.
Yeah, and that's thanks to all the preponderance of tech stocks.
Yeah, it's your FANG stocks mainly. So, and the biggest ones that have really driven it have been Apple and Amazon. Those have been the main drivers. The Netflix, Google's been strong as well. Netflix strongish. Facebook obviously has had a bit of a wobble recently. But by and large, I mean, Apple and Amazon have really been the two major ones leading that. And of course, those are the two companies that were vying for the first company to get to $1 trillion market capitalization, which, of course, Apple won that one.
Yeah, okay. And we'll come back to the Nasdaq 100 as we said. But as I said, our own market had been very, very, very sluggish for a long time. In fact, the range had just narrowed to nothingness, and yet all of a sudden we seem to have broken out of that.
Yeah, that's right. We had gone very quiet, and I sat here week after week saying, it's range bound between 49,000 and 52,500, and then we sort of traded in a range within a range for a while during late July. But all of a sudden, in the last 8 or 9 sessions, this market's really got a rocket under it. And as you can see, we've gone from that day about 2 weeks back, where 10-cent results came out a bit lighter than the market was looking for, and the share price was down in the market. The top 40 consequently was down quite aggressively that day as well. But that was all very quickly forgotten, and we've seen this market roaring higher since then. And you can see here this break above 52,000 is a very significant break from a technical perspective, because it breaks this downtrend resistance that has been intact for the last, since February really. And you can see how that downtrend joins all the high points multiple times over the last number of months. So the fact that we've now broken out above that is actually quite bullish. There's a gap in the chart here at 54,000 from January, and it looks quite likely that we're going to go and revisit that gap at least, and then we'll see what happens from there. Look, at some stage it's going to probably exhaust itself and then it will need to consolidate a little bit. But for the time being, I think it's a case of shorts being squeezed, and this technical break is very much a valid break as I see it here.
Which is quite interesting as well, because there weren't obvious catalysts for the market to break out of the range. In fact, the obvious candidates were for the market to go lower considerably.
Yeah, that's it. And I mean, often the obvious thing doesn't always happen, and I suppose this is a lesson in exactly that. What's happened is that Naspers has had a big turnaround, which has obviously helped. But also the market rally has been a bit more broad-based than just that. I mean, if you look at the other heavyweights, Billiton is knocking on new all-time highs now. Richemont has been strong. Anglo-American's been okay-ish. Naspers, obviously, we've talked about being quite strong. So Sasol is another top 5 stock that is breaking to new all-time highs constantly. So, there has been a fair amount of contribution to this rally. But what's also strange is that the rand has been strong.
Oh, exactly. And I mean, this is, conventional wisdom would suggest that those stocks that you just mentioned should be going the other way.
That's what you would ordinarily think. But the rand has been strong, and that has helped the domestic stocks, so that things like the banks have pushed higher, some of the retail stocks. So it has been fairly broad-based, and I think what is possibly happening here is we're seeing a bit of rotation back in towards emerging markets again. Because I'd seen quite a lot of commentaries to suggest that the discount of emerging markets as a basket relative to developed market was at an extreme low. So I think you're seeing some reversion of that and some money moving back towards emerging markets, which would explain why the rand has strengthened a little bit, and also would explain then that we've seen fairly broad-based buying across the equity market in South Africa.
Yeah, well, it's a welcome relief, I have to say.
It is.
Garth, before we talk about this week's trade, a recent trade that you did for the portfolio was a long position that you took in American Express. And it looked like it was, well, it has been doing what you wanted, and even more so in the last couple of sessions.
Yes, this is one of those trades where it's sort of delivered far better than my expectations, actually. What originally got me into the trade at the beginning of August, and we had flagged it the week before, then we did the trade, and we sort of caught up each week since then. What got me interested was the fact that it was a strong stock within the overall S&P 500 US market. You can see it's trading above its 200-day moving average and above its 50-day moving average. The trend is up, and there was this falling wedge pattern that formed in late July, and the price began to break to the upper end of that falling wedge. And that is typically a bullish continuation pattern, and you would usually expect a move up to then go and revisit the prior highs. So we took that as a trade signal. We went long of 80 CFDs at $100.60 with a stop loss below 98.50. And initially, I was just looking for a move back up to $104, which was effectively the peak that we saw in late July.
Yeah.
But it got there, and I said at the time, well, it was looking quite promising. The S&P 500 was looking as if it was about to push out to the new all-time high. Maybe we should just give this thing the benefit of the doubt and leave it on and see whether we can't extract more out of the trade. And what I said on last week's show is that I would look to run a trailing stop loss using the prior day's low as a trailing stop loss.
Yeah.
So we've done that, and it's actually worked out very, very well. But if you look here over the last 2 weeks or so, you can see every day it's making a higher low on the daily chart. And whilst that is the case, I'm happy to remain long of this stock. If it starts to breach below the prior day low, well, then I'll exit.
Yeah.
But the nice thing about doing that is essentially it allows you to ratchet your position up. So you stay long while the price is trending higher, but if it starts to falter, it immediately catches your trailing stop loss, and you get out, and your profit gets protected.
In fact, and it's probably the only trade this year that you've been able to run a winner, because you've been taking them at sort of 2/3 of the way in, and then kind of banking on the profit. So this is actually a unique trade in a way this year.
It is unique, and it's great to have one that's gone beyond our expectations, and is actually chalking up quite a nice profit for us now.
Yeah. Well, we'll talk about that towards the end of the show, but onto this week's trade, and we did flag the Nasdaq. Why do you like it? Simply because it's strong.
Yeah, it's strong, and it's got a very, very healthy chart pattern here. So if I have a look, there's this upward sloping channel that's been intact since April of this year, and you can see how well that channel has contained the boundaries of the trade. It's recently been down to test the lower boundary of that channel structure, and now there's a triangular pattern evident over here. And typically, I mean, this is a textbook ascending triangle, basically what we've got here. Typically, a triangle pattern will have 5 waves within the structure, and it will break out on the 5th wave. And usually, if you project your triangle boundaries out to an apex, your breakout should happen around about 2/3 or 3/4 of the way into the apex. So, this ticks all the boxes as far as that is concerned. You can see very clearly the 4 waves there, and it's begun on the 5th wave now. That breakout has happened approximately 3/4 of the way into where the apex of that triangle would come into place. So now to take that, you project to get your target. You essentially take the highest point of that triangle, or the broadest point, at the end of wave number 1 here. Okay. You take that distance and you project that distance up to then give you a projected target. And it works out at about 300 points to the upside. So the break above 7,500 therefore projects up to 7,800. And that for me is good enough to warrant taking a trade. And as such, I've done that this week. I've gone long at 75.30, so after the breakout has occurred. Stop loss will be moved below 7,400, and I'm looking for a move up to 7,800 here.
I mean, as you take us through the mechanics of the trade, is this is it a futures position that you've taken? So
yeah, it's a CFD position. The way you do it is you take effectively a bet per point. So let me go through the mechanics and I'll show you exactly how we've calculated our position size here. So my entry point is 7,530, as mentioned. My stop loss is 7,400. The risk, therefore, is 130 points. That's the difference between where we've gone into the trade and where our stop loss would throw us out of the trade. I'm risking 2% of our capital here. Now, we've managed to grow that offshore capital to almost $16,500. So 2% of that is $330. I take that $330 and then I divide it by the 130 points risk per I want to say per share, but per index, if you will. And it comes to a number of $2.53 per point. That's essentially what I could do. So I've rounded it down and I've gone long of $2 per point. All right, so what it would essentially mean then is if we've got $130 or 130 points of risk and we've taken $2 per point, we could lose $260 here. Okay, but we could also make 270 times 2. So what's that? $540. Okay, so this target is 7,800, and my risk to reward ratio therefore works out, as I said, 130 points versus 270 points. If you work that back to simple ratio, it's 1 to 2.07.
Okay, so fairly decent risk to reward ratio.
Yes.
And Garth, before we went in there, you were talking about how clean the chart is. Just explain that it's just a sort of a clean, obvious buy. I mean, is it that obvious?
Well, it's clean. What I meant by clean, if we quickly go back to that slide and have a look, there's no other indicators on this chart. So I haven't got any moving averages here. I don't have any stochastics or RSIs. I don't have volume or anything like that. It's really just a very clean. All we're looking at here is the price. And it's just interesting to do that sometimes. Just look at the price action and say, what is this price action telling you in terms of a potential trade? Sometimes a simple analysis actually can be better than a more complex analysis.
Yeah. Okay. Well, let's see if it's how and if it works out. If we end off with what the portfolios look like, how do they fare?
All right. So our South African portfolio has been a bit neglected lately. It's still up 17.5% for the year to date, so it's done well. But we do need to try and get something happening on this portfolio again before the end of the year. And then our offshore portfolio has been far more active over the past month or so. You can see the American Express trade is now earning us a $500 mark-to-market profit, and then we've entered that Nasdaq position this week. So we're sitting with almost a 10% gain for the year to date on that offshore portfolio as things stand right now.
And then very quickly, just a reminder that you've got a course coming up.
I have. On the 15th of September, I'm doing a high probability trading course in Johannesburg. Anyone that would like to attend, please send me an email, garth@traderscorner.co.za, and I'll email you all the information.
Great. We'll leave it there. Garth, thanks as always for joining us. Garth McKenzie is, of course, founder and editor of Traders Corner.